Let me say something that's going to make every finance guru on the internet absolutely furious. Compounding, the so-called eighth wonder of the world, is completely, totally, embarrassingly useless if you're investing the wrong amount every month. I know, you've heard it 1,000 times. Let your money work for you. Time in the market beats timing the market. Einstein called compounding the eighth wonder of the world. By the way, Einstein never actually said that, but that's a video for another day. Here's the truth nobody is telling you. The math only works if your starting contribution is large enough. And for millions of people investing $50, $100, maybe $200 a month, compounding is not your friend. It's a distraction. And today I'm going to prove it with real numbers. Stay with me because by the end of this video, you're going to completely rethink how you approach building wealth. And I'll give you the actual strategy that works no matter where you're starting. So let's start with the classic example every finance teacher loves. If you invest $200 a month starting at age 25 at a 10% annual return by age 65, you'll have over $1.2 million. And that's true. Mathematically, that number is correct. But here's what they don't tell you. First, inflation. That $1.2 million in 40 years, in today's purchasing power, it's closer to $400,000. That's not a comfortable retirement. That's barely a down payment on a house in a major city today. Imagine 40 years from now. Second, that 10% annual return assumes you're consistently in a broad index fund, never panic selling, never pulling money out, never missing a month for 40 straight years. That's a lot of assumptions. Third, and this is the big one, the compounding in the early years is doing almost nothing for you. Here's the brutal reality. If you invest $200 a month at 10%, after year one, you've put in $2,400. Your compounding earned you $240. That's it. $20 a month. You probably spent more than that on coffee. The compounding only becomes powerful once you have a large base, but you need time and capital to build that base. And if you're only putting in $200 a month, it takes almost a decade before compounding even starts to feel real. Let me show you exactly where the tipping point is. At $200 a month over 40 years at 10%, about $1.27 million total. You contributed $96,000. Compounding did the rest. Sounds amazing, right? Now let's zoom into the first 10 years. After 10 years, you have about $41,000. You put in $24,000. Compounding added $17,000. That's less than $1,500 per year from compounding. Meanwhile, your contributions are doing the heavy lifting. Now look at year 30 to year 40. In that final decade alone, compounding adds over $800,000. $800,000 in one decade from doing absolutely nothing new. So here's the insight. Compounding isn't useless, but it's almost entirely backloaded. The first 2 decades, you are basically just saving money with a small bonus. The last 2 decades are where the magic happens. This means if you plan to retire in 10 to 15 years, or if you need the money sooner, compounding is genuinely not your primary wealth-building tool. Your income, your savings rate, and your investment in yourself are. All right, so if compounding is backloaded and takes decades to really kick in, what should you actually do, especially if you're not in your 20s or you don't have 40 years? Strategy 1. Increase your contribution rate aggressively. The fastest way to beat the compounding timeline is to put more in faster. This sounds obvious, but most people treat their investment amount as fixed. It's not. If you go from $200 a month to $500 a month, you don't just 2.5x your outcome. Because of how compounding stacks, you actually accelerate the timeline significantly. That larger base starts compounding harder sooner. The number one lever you have in your early investing years is not picking better stocks, it's earning more and saving more. Strategy 2. Invest in high ROI assets earlier. Not financial advice, but this is worth thinking about. The highest returns in your 20s and 30s often don't come from the stock market. They come from investing in skills, certifications, your own business, or real estate with leverage. A $5,000 course that helps you get a $20,000 raise pays back 4 times in year 1. The S&P 500 has never done that. I'm not saying don't invest in index funds, absolutely do that, but don't ignore the human capital side of the equation. Strategy 3. Stop optimizing for 40 years from now if you don't have 40 years. If you're 40, the compounding math changes completely. You have 25 years, not 40. Your strategy should shift toward maximizing contributions, using tax-advantaged accounts to their absolute limit, and potentially accepting more risk earlier rather than later. The worst thing you can do is follow 25-year-old advice when you're 45. Now, let's talk about the actual number, the threshold where compounding starts doing meaningful work within a reasonable time horizon. Based on the math, for a 30-year timeline at 10% average returns, you need to be contributing at least $500 to $600 per month for compounding to generate returns that feel significant within the first decade. Below that, you're saving money, which is good. Saving is good. But don't lie to yourself and call it building wealth through compounding. You're building wealth through discipline and savings. Compounding is just a small bonus on top. Above $1,000 a month, now we're talking. At $1,000 a month for 30 years at 10%, you end up with roughly $2.2 million. And in that case, yes, compounding is doing extraordinary work in the final decade. So the takeaway is simple. Your goal should be to get your monthly contribution above the threshold, where compounding becomes meaningful for your timeline. Everything before that threshold, focus on income growth. Here's the wealth formula nobody puts on a motivational poster. Wealth equals income minus expenses times time times returns. Most people focus only on returns, trying to find the best ETF, the right stock, the perfect allocation. But returns are the variable you have the least control over. Income minus expenses, your savings rate, that's where you have enormous control. And time is where compounding actually lives. So the real hack isn't finding a 12% return instead of 10, it's increasing your savings rate from 10% to 25%, investing consistently, and extending your time horizon by starting earlier or retiring later. A person who saves $1,500 a month and earns 8% returns will comfortably outperform someone saving $300 a month chasing 15% returns. Every single time. So let's bring this home. Compounding is not useless, but it is oversold as a magic solution for people investing small amounts over short timelines. The math is real, but the timeline is brutal, and most people don't have 40 years. What actually builds wealth? 1. Your savings rate. Earn more, spend less, invest the difference. 2. Time. Start as early as you possibly can, even if the amounts are small. 3. Consistency. Never stop. Not in a crash, not in a recession, not when the market drops 30%. And 4. Increase your contributions every single year. Even $50 more per month per year compounds in a way most people never calculate. The people who actually get rich through compounding aren't the ones who found the perfect investment. They're the ones who stayed boring, stayed consistent, and stayed patient long enough for the backloaded math to work. If this video changed how you think about your money, drop a comment below. I read every single one. Like and subscribe if you want more no BS personal finance content. And I'll see you in the next one.